It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It is hour number 2 of the Jill on Money show. This is the program that takes the mystery out of your financial life. And today, for our interview segments, I have a very interesting and perhaps strange guest slate. Because most of you guys know that I'm basically a passive investor, but so many of you asked me questions about actively managing your accounts that I had to get guys from Investors Business Daily, which is the newspaper that is for pretty much active investors. Let me introduce my two guests, Chris and Justin from Investors Business Daily. If you want to find out about Investors Business Daily, you got to go to investors.com. If you want to be an active investor, sit up, perk up. We've got a special treat. Justin Nielsen, Chris Gessel from Investors Business Daily. Welcome to Jill on Money. Hi, guys.
Hi there, Jill.
All right, now let's see if we can tell the difference. Justin, you speak first. Who are you?
My name is Justin Nielsen. I've been with Investors Business Daily now for about a little bit over 20 years.
Okay, Chris.
I'm Chris Gessel, and I'm the Chief Content Officer here at Investors Business Daily, and I've been here more than 20 years.
What? Wait a second. What's going on at Investors Business Daily where you guys are sticking around? Are they overpaying you, or do you just love it? What's going on there?
A little of both.
Nice.
Well, maybe they're overpaying Chris. But,
oh, right. I don't want to argue against your next pay increase, man.
Yeah, for me, it's really, there's a fascination with the stock market. And once you kind of get hooked with that, it's kind of hard to leave sometimes.
So tell me a little bit about each of your backgrounds. You know, when you say you have a fascination with the stock market, when did that begin?
Well, for me, I was always interested in financial markets. I have a degree in economics. And I just kind of gravitated towards it. And then I had a chance to make a move from a typical newspaper to Investors Business Daily, and I jumped at it. And I really I love the content, and I like that there was a methodology behind it. And I soon was working with Bill O'Neill, the founder of the company, and it was just a fantastic way to learn about the market.
And you, mister?
Well, I had kind of a different story. I was actually a anthropology major, and my intent was to just do a couple years in the business world and then move on into teaching. And 1 year turned into 2, and 2 years turned into 20. Basically what happened was I didn't know anything about the stock market before I got a customer service job here, just answering phones.
Get out of here.
Yeah, that's what I was doing, taking vacation holds, starting papers up and, stuff like that. And after a couple of years, I had learned enough about the stock market by reading Bill's book, How to Make Money in Stocks. And I actually got his attention and became his assistant for about 15, 16 years. So
let me talk. I want to just spend some time on this for a second because, a degree in anthropology, you are a classic liberal arts guy. And oftentimes we'll get calls from people who are listening to the show, and they'll say, look, I'm not a math head. I'm not a computer person. I'm not a tech person. I don't know anything about finance, the markets. What can you tell them in terms of how you can embrace this thing called the stock market coming from a background like you come from?
Well, I think for my anthropology background, what really is kind of one of the things I think that sets me apart is I had this natural curiosity about the way mankind kind of thinks. And the stock market really just shows that every day. It's mass psychology on parade. And that's what really captured my attention and fascinated me. I was more on the Bachelor of Science side. So I did have a little bit of a math background and some science in there, and understand a little bit about statistics, when I was taking my genetics courses. But I think it's that natural curiosity that will make you go far in learning about the stock market.
Chris, you covered financial stuff and you were a business editor. How have you learned that the masses can take in this information and not be intimidated by it? Because I know that the Investor Business Daily audience is slightly different than the Jill on Money audience. But where do you think they converge?
Really what IBD has done is take the complexity of the stock market and really put it into a system that people can understand, and we have the tools to look at it every day. And then once you buy a stock, know what to do with it, whether it goes up or goes down. And so it really is kind of a whole system of approaching the stock market. And it doesn't take a finance background to understand it. It really just, as Justin said, it takes curiosity. And are you willing to do the work and get your hands dirty?
So let's get into that a little bit, because certainly plenty of people that are listening to this program are what they call the classic do-it-yourselfers. They're managing their own money. Or they may want to manage it. Maybe they're working with a broker right now, or more of like a salesperson who they know is not a fiduciary. They don't putting their interests first. And a lot of people will email us and say, I think I'm throwing my money away. Why shouldn't I do it myself? So let's talk about what makes somebody able to do it themselves. So let's start with the big picture. What is the kind of person who can do it themselves? What traits do they have?
Well, I think you need to first have a desire. It's very hard to do if it's something that you're not really interested in. If you're intrigued by the markets and really want to try to outperform, there just needs to be kind of a passion to begin with, and sometimes that builds up over time. But I think it comes down to you want to do it.
Yeah, I think for me at least, one of the things that intrigued me the most and kind of got me to stay was that I was seeing success in my own personal account. And once you start seeing some success in your own personal account, that can be a little addictive. Now, granted, when I started, it was the late 90s, so I didn't realize that was not how it always worked. I thought that I was just a genius out of college that was getting 80% a year or more, and that was just the way it was going to be every year. I have this silly little Excel spreadsheet that I created of how my returns were going to be by the age of 35, and it just wasn't that way.
Amazing. Was it like, I'm going to get 15% forever?
Oh, no, not 15%. I was thinking I was going to get 50%.
Oh, well, that always happens. That totally
it was
that
the late
happens.
90s.
I know.
That's when I started.
I know, it's exciting. Well, okay, so let's say that you're not necessarily passionate. Chris, you were someone who helped sort of guide the Investor Business Daily's entry into the world of exchange-traded funds. So my question to you is there maybe an interim step for someone who says, like, I really want to fire my broker or my advisor. I want to do it myself, but I don't necessarily have a passion for picking stocks. What about using exchange-traded funds or index funds? How can you make that leap and feel good about that? What do you think is the best way to do that?
Again, you need to do some research and understand how to achieve outperformance. Now, we have a lot of ways to uncover outperformance and let people know what's working. That's a really good point, that if you're not into watching the market every day, you could buy exchange-traded funds and put together a portfolio that with some minor tweaking over time could really outperform the market.
We will get back to our interview with Chris Gessel and Justin Nielsen from Investors Business Daily. Remember, that website, if you want to check it out, is investors.com. When we return, we're going to talk more about this. We'll be right back.
Back to Jill on Money with Jill Schlesinger. Have a question? Call or email anytime. 855-411-JILL or ask Jill at jillonmoney.com.
You're back with Jill on Money. By the way, we get so many questions all of the time, and we really are trying to get to everybody. But please be patient. If you're sending us an email, ask Jill at jillonmoney.com. Mark, are we going to do an all-email segment or what? Show. An all-email show. Because I think that's what we're going to have to do, don't you think? We're backlogged on them emails. So if you want to get on the show, of course, no problem. Ask Jill at jillonmoney.com. Maybe when I go away, that's what we should do. Some of those August weekends. Where am I going? I'm going away. Mark always wants me to give more information, but I refuse to. I want a bit of privacy. Anyway, so let's do that. Let's try to get a bunch of these emails banged out, and we'll give you an all-email show. But today we are talking about how to manage your own money. And if you are managing your own money and investing yourself and you want to be active, what is your goal? How should you measure your success? That's what our guests, Chris Gessel and Justin Nielsen from Investors Business Daily, are talking about in this segment. Is the goal, do you have to have the goal be outperformance? What if you just want market-based returns? I want the stocks to do what the stock index does, the bond to do what the bond index funds. Or is that so boring for you guys? I can sense that you think that's terrible. I feel bad that that's so boring to you.
Well, I will say, if that's your goal and you don't want to pay an advisor, go ahead and buy SPY, S-P-Y, the S&P 500 ETF. There's all sorts of basic ETFs that are extremely low cost, much less than you would, a mutual fund or what a financial advisor might charge you. So there's definitely an easy way to match the market and not put a lot of time into it.
But the one thing I would say is, if you're going to take that route and be a passive investor and say, I'm just going to be, an index fund. And again, there's so many products out there now that can get you those market returns, but you have to take a long-term approach. You can't be, I'm a passive investor as long as the market's going up, and then when you get a financial crisis, decide, now I'm going to become active.
Right. I'm passive as long as it's going my way.
Yeah, we've talked to a lot of people who've only been investing, or not only, but have been investing since 2009. And so I say, well, do you have a plan for a bear market? And they kind of look at me quizzically and say, well, I think I'm going to be a buy and hold investor. Yeah. Which, until you've, experienced a major correction, it's very hard to sit through and have that conviction.
Last year, 2017, the biggest correction, quote unquote, in the S&P 500 was about 3.4%. So for people that started, more recently in 2017, they just didn't think that the market really had much in terms of the way of going down. Mm-hmm. And so this year started, and you saw an immediate 10% correction, a little bit of jostling back and forth and coming back, and then another 10% correction. And I think that was a wake-up call for some people, is that, this is this is the way the market actually works. 2018 is a lot more representative than 2017.
Right. Certainly in terms of volatility as well, like the ups and the downs and back and forth, and it makes you a little crazy. So I am mostly a boring passive investor because I'm lazy. And I think that by and large, I think that I have really been in my life clinging to research that will basically find that actively managed mutual funds don't keep up with plain old index funds, right? And, this is like the Charley Ellis approach, right? You guys really like active investing, but there's a caveat. You really only like active investing for certain types of people. So we talked about the kind of person, who can do it themselves. So there's a desire, passion, like you want to do it. You have the time and the energy to do it. What do you need to be an active investor? Because, if the big guys can't beat the index, how can we as mere mortal individuals do it?
One thing is that individuals have a lot more flexibility. A big guy cannot get out of the market in a day. Whereas as an individual investor, if you see your indicators are showing you that the market is rolling over and maybe you're thinking that there's a bear market coming, you can get out quickly. So flexibility makes a big difference and is actually a big benefit to being a smaller individual investor. But by the same token, again, this goes back to the whole system thing. You need to have system and rules and the discipline to follow it, because if you get out and you're wrong, are you going to get back in when the market starts making new highs? Or if you get out near the top and you watch everything sell off, do you have the conviction to get in? Maybe not right at the bottom, but once the market has turned. So those are the things that you learn over time and really require study and the will to proceed.
And one other thing that happens a lot of times with the experts, and why these active managers don't necessarily outperform a larger index fund like the S&P 500 or something like that, is because of their size, sometimes they're diversifying so much that they almost become closet indexers.
Right.
You know,
Right.
so it's very hard to get outperformance if you've got so many stocks that you're matching the S&P 500. How do you outperform it if you've basically got the same number?
They're also going to charge the fee. And I mean,
Right.
I guess that as an individual, the other point to make is I'm arguing around against my original thesis, but I mean, one of the reasons why most people were really bad at trading their own portfolios is the costs were eating them alive. But now essentially you can trade stocks for zero, right? I mean, like peanuts. And so now all of a sudden you can trade stocks, but you're not having to pay, 1% of your total portfolio. That may have something to do with it as well. One thing that you guys are very clear about is that as an individual investor or an institutional one, whether you're active or passive, from time to time you make a mistake. You're right. You let the winds of markets move you around. You say that it is imperative that you realize that you're going to make mistakes. Why is that?
Well, because everyone makes mistakes. in the
Thanks,
market.
Dad. I know.
And it's true. If you cannot take being wrong, then active investing is not for you, because you are always there. It doesn't matter how great you are overall. If you have a 60% win rate, which means if you're managing your money and positions correctly, you can make a ton of money. But that means 40% of the time you're going to be wrong in your stock picks. So you just have to accept that and have rules to deal with it. So one of the main elements of questioning yourself, can I be an active investor, is can you admit you're wrong? If you are wrong, can you cut your losses short and don't let little losses become big losses, because that's when you can really get into trouble.
And do you have a system? We've talked about that you systematize things. When you look at that system, do you find that even people who say, yeah, of course I'm going to stick with the system, are falling prey to the same problems, which is they try to trump the system when things go against them?
Well, we find that the biggest problem people have is being human.
Damn it.
If you
Damn it.
have those human emotions, you're going to fall prey to a lot of those thoughts of, oh, it's down 8%, but maybe this will come back. I don't want to look stupid if I sell it here and it comes back without me. That's something we all suffer from. And it's not until you can learn, oh, you know what? This is my insurance policy. This is I'm taking the loss at 8% because it could go down more. And the math just works against you if you let something go down too much.
Yeah, and you also say, which I find very funny, which is, can you fight the urge to bargain shop? Can you talk about that a little bit?
Our whole philosophy is we buy on strength. We're not trying to buy the beaten down stocks, the ones that are on sale. And that can be very, almost anti-American. I mean, who
Really?
goes car shopping looking for a car that's trading at the highest price it's ever, been sold at? So what we're trying to do is we're not trying to buy something for consumption in this case. We're trying to buy something that we're going to sell later. And for that reason, buying on strength is a critical component. And that means often we're buying stocks that are trading at or near their new highs. And that goes completely counter to what most people want to do.
We will get back to our interview with Chris Gessel and Justin Nielsen from Investors Business Daily. That website, by the way, is investors.com. Pretty good domain name, huh? And the other domain name you should think about is Jill on Money. There you can read, watch, listen to all the fun stuff that we do. JillOnMoney.com. We'll be right back with our interview with Justin and Chris.
Wondering how to make your money work for you? Get on the line now, 855-411-JILL. Back to Jill on Money with Jill Schlesinger.
Well, we are smack in the middle of this great interview with Chris Gessel and Justin Nielsen from Investors Business Daily, and we are talking about managing your own money. Of course, one of the things that many investors know way back when, and when I was starting, they would say to me, we've got to look back in order to look forward. We've got to look at what has happened in markets to understand how to help you navigate going forward. Now, sometimes that history can really lead you astray. So, for example, you could say right after the financial crisis, every time you think something weird is going to happen, the market's going to completely collapse and have a once-in-a-generation slide. Or you can say, wait a minute, let me take a longer view of history. You might say, okay, even though the market has just gone through this long slide, how many times has that kind of slide occurred? According to Chris Gessel and Justin Nielsen of Investors Business Daily, history is actually a very good guide for those folks who are looking to manage their own money. Here's more of our interview. How does history play into the system?
The whole IBD methodology called CAN-SLIM, which Bill O'Neill developed, was based on his analysis of past stocks, the history of the stock market. And he was looking at how the best stocks looked before they broke out, and then how they acted on the way up, and then what they did at the top. And in addition to that was what was happening in the market. So it's all about history. And none of this is based on opinions. It's based on what has happened in the market before, and it just continues to happen over and over again.
And after you've been at this for a while, you kind of realize, again, mass psychology, human psychology, it just doesn't change. Sure, we have all sorts of technology that's changed, and you can, as opposed to calling up a broker to put in a trade and then getting a call 10 minutes later to find out if you got filled, now you do it with a click of a button. So sure, the technology has changed, but if you look at some of these past charts or the critical components of these past winners, you look at RCA back in the 1920s, it looks like an internet stock in the 1990s because the radio was so important at that time, and RCA had a phenomenal move. And so it's not until you start seeing this history of these past winners, what did they have in common? We're not looking at the market as a whole. We really have identified this subsection of these market winners, these big performers. What did they look like? And we try and look for those similar characteristics.
I think that many people have like one little account. They're like, this is my fun money account. Because I think that a lot of people are hearing what you're saying and saying, like, that's not for me. That's like too scary. I wouldn't do that with my big money. I mean, yes, of course, I like history and all that. But what do you think about taking a small amount of money? Because this is what I usually tell people who call. Look, you want to go play, you want to go learn, you want to get immersed in this. Take some amount of money that's real enough that you're going to get a little yah-yah out of it, but not so big that if you blow it or you find that you really don't like it, or you don't think you're very good at it, that it won't kill you. Can you sign on to that as like a good piece of advice for me to give to people?
That's a fantastic way to just test whether you're really up for handling your own money. And it's a much better way than paper trading, because people will often do that, and it's easy to ignore the fact, like, oh, I would have sold it this day, but I decided to hold it, and all that, those sorts of things that people do to justify inaction or action.
Right.
And when you've got some money on the line, it changes everything. And it needs to be enough that if you make a mistake, it's going to get your attention, but if you make a gain, it also will really jazz you up and perhaps spur you to become even more committed.
And this does require some training, training your mind, training your emotions to be in check, and learning the rules. And so, I absolutely agree. There's a lot of times where you kind of need to make some of those mistakes on your own. I remember personally, I read the book, and started trading immediately thinking I knew everything. But, that was youth, talking as well.
Oh, the folly of youth.
But, I quickly, discovered, wow, I made this mistake. I reread the book, and it was almost like a completely different book to me, because now I had this experience that I could, go back to and say, oh, that's why he said to do this, or, what have you.
Once you've made the mistake, I guess the other part of this is, like you said, that, you have rules. Maybe you were like a gut investor. Like, I always love those people. I interviewed this woman. Her name is Annie Duke. She wrote a book called Thinking in Bets. And she talks about how in poker, she's a world champion series poker player, right? And she talks about how to be a great poker player, you must be able to stick to the rules, and that the guys or the gals who are like gut players essentially are going over the long term are going to lose. And you also are saying that the rules that you apply are really important here, right? And so if you find that you've failed and you go back and you say, aha, here's what happened. I didn't stick to the rules. Let me try it again. Then let me ask you, what would be another clue that, let's say you still don't do well? What do you think could be one of the causes of not doing well if you're trying again? If, let's say you are sticking to the rules and you're really doing it and you're admitting that you're wrong, but it just doesn't work for you. Maybe it's the market cycle. What advice do you have for people?
I think you've touched on something really important. The rules have to be applied in a proper market. So most stocks follow the trend of the market. It really is difficult to manage a portfolio that outperforms or even sticks with the market if the market is going down or in a choppy sideways pattern. One of the most important things that we spend on each day is looking at the market itself and judging, are we in an uptrend? Is that uptrend maybe starting to deteriorate? Or are we in a full-fledged bear market? And your actions are completely different in all those different situations.
I also want to make sure that your listeners realize, getting back to our original point, you're not going to be right all the time. So just because you have a stock that went down, it didn't work, you might find that you did apply the rules properly. It just didn't work that time. And going back to your analogy about Annie with the poker, she gets bad beats all the time.
Right.
But because she applies her rules consistently, that's why she makes it to the final table a lot of times. So, she might not make it every time, but that's not because she broke the rules necessarily. Sometimes they just don't work out. But if you're very systematic, consistent over time, you're going to find that you're going to have some market-beating performance.
We'll get back to our interview with Chris Gessel and Justin Nielsen of Investors Business Daily. If you'd like to sign up for our free newsletter, how about that? Free. That's a good number. Just go to JillOnMoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
Well, you are back with Jill on Money, and big news here at the show is Mark's trying to gear up to take that big certified financial planner exam. When's the open window when you can sit for the exam, Mark? So he's got some time, but we'll be doing some flashcards over here at the show. Don't worry. Okay, so we've talked a lot about some of the evidence around market timing, which makes managing your own money very difficult because we are human beings, and that's tough to deal with. We just are. But our guests, Chris Gessel and Justin Nielsen from Investors Business Daily, they may think that whether or not you've got experience or not, if you're going to start managing your money, do so with small amounts. Here's the end of our interview with Chris Gessel and Justin Nielsen. For most people, as you said, the critical issue is that we are human beings. So what I would like to propose, if you guys will go along with me on this, let's see if I get your buy-in.
All right.
We got a lot of people who think they can time the market. So you think you're so smart, again, take the amount of money that, again, a sizable amount that will keep you excited and occupied, but not too much to blow up your whole financial plan. Because I know you're going to do it anyway, right? There are some people who are going to do this, right? But let's have them get a taste of this and go out and subscribe to your IBD or go to IBD.com, but educate yourself. That's the other part because, this takes a lot of time and you may or may not find that you like it. Would you guys go along with the, hey, let's try it and see how we do versus go all in? Are you okay with me pitching that as the idea?
Well, I think one of the critical components that you put as a part of that is educate yourself. Mm-hmm. If you think you're just going to walk in and because you've got a pretty face, you're going to be great at the market, or because and this is actually even worse, because you're so smart. I can tell you there's plenty of doctors and lawyers that are very smart people that are not great at the stock market. If you have that thinking that you can do no wrong, that's the wrong approach to the market. And if you aren't willing to educate yourself, learn. Now, in terms of the time, we do have a lot of time-saving features in our products. That's what they're kind of built for. And the whole reason we can do that is because we've got a lot of automated rules. We use the computer to do screening for us, and that just really helps cut down quite a bit of time. But you still have to educate yourself. And if you think you can go in without any rules or any education, yeah, you're fooling yourself. But if you can spend some time on that, learn the rules, and as you said, play a little bit with, a small amount, get the rules down, know that you're following them, do some post-analysis, learn from your mistakes, then you can really have phenomenal performance and really contribute to your financial freedom.
All right, last question. Let's say that I am the kind of person who I'm not going to do this. I'm just not going to do it because it freaks me out. I'm scared. And I even have a certified financial planner or someone I work with, and I really like that person. What can I learn with IBD? What am I going to learn there by, versus any other financial publication? Should I avoid it? Should I not do it? What's going to be there for me?
Well, I think you can learn a lot about what's happening in the market and then just kind of inform your overall understanding and makes you better informed when you deal with your financial advisor. The other thing is we have a lot of coverage on exchange traded funds. And so again, if you're not an active investor, you can be a smart passive investor and go for outperformance in those indexes. You don't simply have to just try to match or be close to the S&P. I'll tell you, we've taken our methodology of how we look at the market, and we've created an index that is licensed to an ETF provider, Innovator, and it's the IBD 50 index ETF. The ticker symbol is FFTY. Last year, that was the top performing ETF among diversified U.S. stock ETFs. And the reason was we were in a decent market, tilted towards growth. And just because this is on automatic pilot, it follows the rules, it vastly outperformed the market. I think it was up about 37% versus 19 on the S&P. So we've seen this kind of outperformance long term. We've been publishing this index since 2003. It works because it's based on history.
It's fascinating. I'm listening to you guys and I'm thinking, oh my God, my listeners are like, I thought you hated this active stuff. But one of the reasons I wanted to have you on is that I know that people are interested in it. Okay. So I guess that it's like I don't want this to be the gateway drug, number one. But I do want you to know that I so appreciate you joining us, and I didn't go hard at you with everyone's going to screw themselves, because that's not the case. And I do think that from time to time when we get these kinds of questions, I want to be able to say to people, hey, you know what? You're going to do it, then do it this way. And, do I think that there could be people who are very happy taking advantage of your systems? Sure. I think that those people are probably finding themselves frustrated with maybe they're a little bit at sea themselves. And I also think that there are people who are out there who are working with advisors, and they are so-called advisors, and they're not getting advice. They're not getting financial advice. They're getting stock picking, which, frankly, I don't know, a lot of these big wirehouses aren't better at it than you guys are at it. So maybe that's the other piece of this, which is, if you want to save money and you want to do it yourself, be sure you're not going to shoot yourself in the foot. Start small. Follow the system. Well, thank you so much to these lovely gentlemen, Chris Gessel and Justin Nielsen, who, by the way, up early on the West Coast to do this interview. So thanks again for that. They are from Investors Business Daily. If you want to find out more about Investors Business Daily, just go to investors.com or click on some of the links in our show notes. It's Jill on Money. When we return, one last question from one of you. We'll be right back. You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our phone number here is 855-411 Jill. See, I did it really fast, Mark. No one will use it. It is? Okay. Mark wants to receive emails, so that's why don't call him. I think that we should probably phase out the phone number anyway. What do you think, Mark? Should we just get rid of it? He says there's no harm in keeping it, but you don't even like when people call because we get some drunk dialing, we get crazy people. Anyway, you can go into more detail when you actually send us an email. Ask Jill at jillonmoney.com. That's the email address. And that is what Arnold did. Hi, Jill. What am I not seeing? I am retired at age 70. I have $375,000, my total retirement funds. About a third is in 401ks, the rest in a few assorted Vanguard funds. I live a quiet and simple life now. I'm divorced, kids are grown, married on their own. $8,000 car loan, period. My income in retirement is $300 less monthly than my actual expenses. Woo! At this rate, my money will certainly be adequate to support me and leave a small inheritance for the kids. On the radio, I hear people with retirement funds of $1 million and more, and they're not sure they have enough. What am I missing? Are they trying to live extravagantly? I enjoy your show. I listen when I can. Thank you. Yeah, I mean, look, this is all about everyone's individual needs. So, think about this. You say your income is only $300 less than your actual expenses. Well, most people aren't in that situation. And I just spelled this out for somebody. A colleague of mine came up to me and said, I really need about $100,000 a year to live on in retirement. I said, okay, fine. Tell me what you got. And he says, I got a Social Security check and I'll have a small pension. And those two things together will be $50,000 a year. And then I got $1 million in my 401k. So I should be all set, right? No, because the $1 million in your 401k is only going to give you about $35,000 a year, and that's taxable. So either you got to live on less or you got to keep working. Guess what? He didn't like that answer. But I'm glad for you, Arnold. Congratulations. And thanks to all of you who have listened to the program. Remember, if you want more information about investing more actively, which I don't necessarily think is the best thing, but you can check out investors.com. Investors.com. You got a little itch and you want to scratch it. Check that out. Thanks to Chris and Justin for joining us on the program. And thanks to you for listening. We'll see you next week.